Not only is not all debt bad, but there are types of debt that you want more of. So much so that you should be taking money out of your own pocket and laying it down to get more of it. The beautiful thing is that with compound interest and time in the market, you can take even small investments and turn them into large financial outlays. Me, myself, I'm never gonna retire. I'm gonna go hard and make as much money as possible till the day I die. The internet, social media, am I right or am I right? There's a bunch of misconceptions on a number of topics, and they're always spreading like wildfire all over the place. And in the space that I occupy, talking about finances and things of that nature, there are 7 common misconceptions. Let's talk about them today. I'm Derek West, you're watching Finance Squared. Like, subscribe, click the notification bell, and while you're in the engaging mood, drop a comment down below with some common misconceptions you run across, and maybe I'll talk about them in my next video. Let's talk about a big one. Rening is throwing money away. I'm one of these individuals that is a little skeptical of the so-called American dream. That is to say, owning a home is the best financial decision that you're gonna make. I'm not sure if that's the specific American dream, but I do know that people advocate for owning a home probably more than they should. Owning a home, in my mind, is really one of many good financial decisions that you could make. But also in my mind, there are other quality financial decisions that you can make that can and probably will result in you being more wealthy if you just follow them. And because of that, if you're following and paying attention to these things and you're executing a financial plan, then if you are renting and you don't own a home, you shouldn't really feel that bad. I mean, it needs to be said that renting can be a smart choice, depending on your financial situation. How flexible are you? What are the costs associated with homeownership in the area that you're trying to live in? We all know about maintenance, property taxes, and interest on mortgages. And if you've been watching my channel, you should know that paying interest on a mortgage over the lifetime of a mortgage, which is typically 30 years, can result in you paying twice as much for a house or home that you choose. And if you fall into the trap that investing in a home is the American dream, is the ultimate financial asset, or one of the most important financial assets that you're going to purchase in your life, probably also going to fall for the fallacy that the more expensive the home, the better off you're going to be, which is oftentimes not the case. So if you're not focused on home ownership, don't feel bad. Now, this is not me saying that owning a home is a bad thing, or even that owning a home is bad for you financially. Owning a home is good for you financially, and owning a home is a good thing. But if you don't really feel like it, if you're not that motivated, don't feel pressured to get into a home, particularly if you're not ready, particularly if you can't find a home within the price range that suits your budget and your financial goals. That's all I'm saying. And I like to kick off videos like this with that particular peccadillo of mine because it's such a common misconception out there. But the next most common misconception that you're going to hear all the time is that all debt is bad. You're going to hear a ton of talk from all voices, all corners, all comers, that debt is always harmful and should be avoided at all costs. Well, actually, that's not true at all. Strategic use of debt, when used properly, can lead to future opportunities. Also on this channel, one of the themes I like to talk through is that there's such a thing as bad debt and such a thing as good debt. And as a matter of fact, there's 2 types of good debt. Bad debt is purchasing any asset that depreciates in value over time. Good debt is taking out debt, credit, loans, etc. to purchase assets that will appreciate over time, more than likely. Obviously, there's risk involved in a purchase of debt of any kind. But the flip side, and why bad debt is so bad, is that with bad debt, you're definitely going to be paying for an asset will be depreciating over time very quickly. That is, of course, unless you use credit and debt techniques to help you avoid such things. I talk about that sort of thing on this channel as well, but in this particular instance, what you should be doing is you should be avoiding bad debt. And I would probably say you should have 0 bad debt on your books. Now, the first point I made earlier, that purchasing a home involves a ton of debt. There is an argument with good points on both sides of whether or not purchasing a home is good debt or bad debt. I don't really fall down in any category. I just know that you shouldn't really be pressured into purchasing a home because there are other financial decisions that you can make that will and can make you wealthy as well as purchasing a home. But aside from that, good debt can put you in a good position. For example, taking out a loan to start a business. This one's a touch exotic, but taking out margin in a investment platform to own stock or execute a short position. Like I said, that's a touch exotic, and we can get into that in future videos. But there's also an argument to be made that student loan debt is good debt. Like with anything else, you need to be careful with good debt and bad debt, particularly with student loans, because quite honestly, a lot of colleges and other financial institutions are ripping kids off and ripping people off with worthless degrees that don't really match up to the loan outlay that they just made. Another video for another time. And I haven't even gone over the second kind of good debt. It's one of my favorite kinds of good debt, actually. What I'm talking about are fixed income instruments. And in reality, these fixed income instruments are debt. Debt which you want to get more of. Debt which you are purchasing. Not only is not all debt bad, but there are types of debt that you want more of. So much so that you should be taking money out of your own pocket and laying it down to get more of it. So what I'm trying to tell you is, not all debt is bad, some of it's good, and some of it you really want. The third most common misconception is you need to be wealthy to invest. Only people with significant wealth can invest in the stock market or other assets. I'm sure you've heard of that being bandied about. Well, the truth is, with the rise of micro-investing platforms, you know all the big ones out there. But not only that, low-cost index funds, ETFs. Almost anyone can start investing with small amounts of money. The beautiful thing is that with compound interest and time in the market, you can take even small investments and turn them into large financial outlays. So no matter how much money you have, you always have the opportunity to begin to invest. And it's never too late or too early. I'll talk about that in a little bit. Now, I spoke a little bit earlier on debt, and that it should be avoided at all costs. That takes me to another one of the most common misconceptions that you're going to hear, that credit cards should be always avoided. Now, in my opinion, credit cards are indeed something that you want to consider carefully, because if you're not careful and if you're irresponsible, if you lack discipline, credit cards can and do turn people's finances upside down in a bad way. What do I mean by that? I'm talking about people carrying high interest balances month to month. In those instances, when you have those balances that are high, that's when interest is charged, or a ton of interest in any case, is charged to you. The smartest way to handle credit cards is to use them to purchase goods and services that you're going to purchase anyway. Your groceries, gasoline, maybe even rent. By keeping in the back of your mind, you should have the money to pay for those things already secured and ready to pay off that credit card balance as soon as possible. I even have a patented pending credit card technique based off that whole process. I'm going to talk about that in a future video, so make sure you're liked and subscribed. That just points to the fact that credit cards are not that bad, particularly if you know what you're doing. Make sure that you do and use them wisely, because it can in fact return to you good rewards, good bonus points, and help you to stay ahead of the game. Another common misconception: financial planning is only for the wealthy. I can tell you from experience that if you're not wealthy, that's probably when you need the most financial planning. A lot of people think of financial planning as somebody getting into their finances and purchasing stocks and bonds and moving them around for them. That can be a part of it, but financial planning extends far beyond that realm. It really is about budgeting, saving for emergencies, planning for retirement. If you're the kind of person that's looking to retire, me myself, I'm never gonna retire. I'm gonna go hard and make as much money as possible till the day I die. Maybe not to the day I die, but probably close to it. But all of these things are essential regardless of your income level. And the earlier you start financially planning, the better off you will be in the long run. I think a key point here as well is that you don't necessarily have to hire a financial planner. It's just that someone has to do it. You can start off with you, and you can then hire someone else if you run into places and circumstances that you don't know about. For example, if you need more knowledge and guidance with investing in stocks and bonds and Forex and other things of that nature, and you don't want to just get off of a YouTube channel or a TikTok channel, then financial planning and planners are right for you. If you want to get an understanding what an investment horizon is and what your investment horizon is and how you should plan, allocate your finances based off of that, then financial planning is for you. And another key point is that it doesn't have to be forever, but just getting the pieces that you need in place and the knowledge that's going to help you move your finances in the right direction. That's going to be a key thing no matter what level of finances or where you start off with your financial journey. Another kind of misconception is that, it's too early to start investing, or it's too late. I already missed my window. College kids, high school kids oftentimes think it's too early to worry about retirement. I can handle that later, right? And older individuals might feel like it's too late to start saving. In both instances, you're wrong. It's never too early or too late to save. Starting early allows you to really take advantage of the power of compound interest. The earlier you start, the more momentum you can build. The more momentum you can build, the more money you're going to accumulate as you go on towards your later years. But at the same time, what typically happens when someone gets older is that they get better with money as time goes on. They get more skills as time goes on. That combination can lead to you being able to accumulate more money than you thought, even though you started a little bit late. So don't worry about the time frame or what age you are. The best time to start investing was yesterday. The second best time is today. The worst time is sometime in the future. So start today. Probably the biggest financial misconception that people have is that having high income means financial security. Everybody wants to earn a lot of money doing various things. One of the big things that I try and tell a lot of people, so I happen to run into a lot of people that make a lot of money, must be my line of work. What can and does happen quite a bit is that people that make a lot of money also spend a lot of money. And this brings a good point, that financial security is more about how much you save and manage your money. It's not about how much money you make. Technically speaking, it's not about how much money you save. It's about how much money you invest. One of the big things that I talk about here on this channel is avoiding lifestyle creep, sometimes with lifestyle inflation. You see, lifestyle inflation is when your expenses increase and rise at the same rate that your income rises. That means that no matter how much money you make, your spending rises along with it, and therefore your ability to save and your ability to invest goes out the window. The positive of that is that you're gonna be living a pretty good lifestyle, driving fast cars, living in big houses, taking expensive vacations on fancy yachts, flying in private jets. Sure, that can be a fun and rewarding lifestyle. But in the end, when the income dries up, and it will, in a lot of cases, it always does, then you're gonna be left with nothing, and your wealth really won't grow that much. The way you want to think when you have a high salary is that you now have the potential to be wealthy, not that you are wealthy. Wealth in reality is how much your money is working for you, not how much you're working for your money. And lifestyle inflation can erode wealth, and without proper budgeting, saving, and investing, high earners, just like anybody else, can face financial trouble. So let me know in the comments down below. What are your thoughts on these 7 financial misconceptions? Did I miss any? Do you have financial misconceptions that you have? Let me know in the comments down below. Maybe I'll talk about them in my next video. That rhymes. It's pretty awesome. I'm Derek West. You're watching Finance Squared. Like, subscribe, click the notification bell, and remember that a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'll catch you in the next video. Peace.